So on page 8, hedges, you can really read through this yourself. You guys have taken this stuff in finance and so on. But what I want to do is talk about what a hedge is against an operating transaction, and then why we might use what's called hedge accounting, which is optional. If you can go back, so just read this whole page, but go back to page 7. And that's where I want to kind of just illustrate how a hedge works in case you've forgotten, or just to refresh your memory so we're on the same page. So on page 7 we left this little space. So I'm just going to call it a little hedging diagram. And let's say we make a sale to a Filipino company for 1 million pesos in 60 days. So this is our export. Our company, Filipino company, and we're making a sale, so inventory is going this way, and we are going to get 1 million Filipino pesos in 60 days. So just thinking about that, if the Filipino peso goes up, the exchange rate between that and our dollar, the Canadian dollar, goes up, we are getting Filipino pesos. So if it goes up, is that good or bad for us? We're getting them. So it's good. It's going to be a gain. But as we know, this gives us a level of risk in our company because it might go up, it might go down. Okay? The uncertainty gives us the risk. So what we do is use a forward contract that we just learned in the last video to hedge against this. So we're going to do the opposite. We're getting pesos from this operating transaction. So we're going to make a forward contract to give 1 million pesos in 60 days. So our company and a bank or foreign exchange or whatever is going to give 1 million Filipino pesos, and we're going to get Canadian dollars in 60 days. So this time we're giving. So if Filipino pesos go up, we're giving. So it's bad. Remember, I'm using bad and good when they're really not judgmental words, okay? Just for you to figure out, is it a loss or a gain? So it's a loss. So we're in a perfect position. If it goes up, it'll be balanced here. If it goes down, it'll be balanced here. The key thing is we're not trying to make money off this. We're trying to reduce the uncertainty. And by going in the opposite direction, we've reduced the uncertainty because we won't lose overall. Now, there's one little thing. When you enter into 60-day forward contracts or 90-day or any kind of forward contracts, there's always going to be, well, first of all, there's going to be transaction costs, just assuming there's zero. But the exact spot rate changes are not going to equal the forward contract rates, right? Because one's fixed, whereas the spot rate is every day, so it can change up and down every day. So it wouldn't necessarily come out exactly even, but we're not concerned about it. It's the idea. So this becomes, the X becomes the hedged item, and the forward contract becomes the hedging instrument. So that's how you do a hedge. Now, you know that from finance. Now, where we run into the thing with accounting is when we do accounting, one of the things we're supposed to do for our shareholders is give them more information, or as much information as we can. So one of the pieces of information we want to give them is information over whether our hedging is effective. So when we do this, we could do normal accounting, and we would show, oh, here's our gain, here's our loss, and you can kind of match them up. So that works great when you start with the sale and the forward contract at the same time. So if this is a little timeline, goes the sale, over here's the settlement, and here's year end. So you would have gain and the loss both recorded here, and any additional gain and loss would both be here, and they'd be matched up. However, sometimes we enter into contracts, example for a sale, and we don't record it right away because the earnings process hasn't been finished. So we might get a situation where instead the forward contract is recorded here, but then the sale recorded here. So all of a sudden, the gains and losses don't match up. For accounting purposes, because we haven't even recorded the sale, we'll only be recording it here, even though we entered into the contract here. Okay? So, in this scenario, because this happens frequently, accountants decided to come up with hedge accounting. And hedge accounting is an optional thing, you don't have to use it. But they came up with two methods to record the operational transaction and the forward contract when the timing doesn't match up. If it matches up, it doesn't really matter because your gains and losses will be offset. But when one is recorded and not the other one, it's not matching, so they came up with two different ways to do it. So, that's what we're going to talk about now, and I'm going to go into a little bit more detail on what kinds of transactions would cause this scenario and how we would deal with it. Okay, so on page 9, because 8 you read, page 9 has the information I want. Pretty much page 8 was what I just told you by drawing the little diagram, which to me makes a little bit more sense. Okay, so a hedged item can be a recognized asset or liability, a firm commit that you either recognize, record now, or unrecognized, record later. A highly probable forecast transaction. So let's say we were Booster Juice. We know every year we have to buy fruit from, say, the US. So these are highly probable. It happens every year. So we can say it's a hedged item. So the firm knows they will be entering into these transactions in the future. Or it could be a net investment for operations. We're not going to worry too much about that one. They must be able to be reliably measured, and the hedges can be designated for accounting purposes as fair value hedges. So these are the two kinds: fair value hedges, cash flow hedges, or hedges of a net investment in foreign operations. Again, we're not going to worry about that too much at all. These are the two I'm concerned about. So, in a fair value hedge, the entity uses a hedging instrument to hedge the fluctuation in the fair value of the hedge. Now, this can be used for recognition of assets or liabilities, including ones involving foreign currency risk, and unrecognized commitments. And what happens is the gain or loss in the fair values of the hedging instruments and the hedged items are both recognized in profit or loss in the period of the change in values. Gain or the loss on hedged item is recognized early in net income. So that's a value hedge. In a cash flow hedge, the entity uses a hedging instrument such as a derivative like a forward contract to hedge against the fluctuation in the Canadian dollar, such as future sales or purchases. So what happens is the gain or loss on the hedging instrument is initially reported in OCI and later reclassified to profit. So this cash flow method can be used for recognized assets or liabilities, foreign currency risk in a firm commitment, but not any other risk, and this is where the highly probable forecast transactions, they have to use the cash flow hedge. So for this, the hedging instrument are put into OCI, then into net income. So there's a ton of different hedging instruments, or just foreign exchange contracts, futures contract, options, all the different of derivatives. All we're going to care about is foreign exchange contracts. So hedging recognized monetary item, this has already been recorded. This shows accounting would be done without hedge accounting, because in this case, the gains and losses are in the same time period. Even if you did hedge accounting, the results would be identical, and so you don't really need to do it. If you look at page 15, 16 in the notes and in the text, I've got it there. You can look at it. It's not a big deal for what we're doing. However, hedging an unrecognized firm commitment is, and that's what we're going to do. So let me just talk about it first, then we'll do an example in the next video. So unrecognized firm commitment, the hedged item is not recorded in our books because the transaction hasn't taken place, but its likelihood 80%. So it's not highly probable